Tēnā koe hoa. Nice to have you back. Today's session, revision 6, is going through the adjustment we did in revision 5, and we're going to adjust the 6 adjustments that are the level 2 adjustments, the ones that don't require a new asset or a new liability to be created. In this we're going to do some calculations. Before we start though, I'd like you to write down here the trial balance and the adjustments into your workbook that we've been working in, your 1B5. Excellent. Okay, press pause if you need more time. Right, here we go. So what we're going to do is we're going to go through each of these adjustments one at a time. Remember, the debit side is where we've got our assets, our expenses and drawing sometimes. On our credit side is where we have our liabilities, our income and our capital. In this case, however, we've got what we call contra assets. Assets are negative assets. So we've got negative property, plant and equipment with furniture, equipment and vehicles. And we've got a negative current asset with the allowance for doubtful debts. So we're going to start off with the first one. As we go through each of these, we're going to cross them off. The first one is the bad debts to be written off, $920, including GST. Because it's including GST, we need to separate the GST out by dividing it by what? Good, 1.15. So on your calculator, 920 divided by 1.15. Oh, try that again. And you see that's $800. So we're going to write those figures in. We're going to write in 800. And the GST portion of that will therefore be 120. The 920 we're writing off includes 800 bad debt and 120 GST. So we're going to do each part separately. The account receivable part first. So the 920 comes out of account receivable. So cross that out, take off your 920. And you'll notice it's a nice even figure. Examiners like this because it makes the allowance for doubtful debts easier to calculate. So we've done the 920 part, we can cross it out. The 800 part's the bad debt, so we'll add that to our bad debts. Alright, and the 120 is the GST. Now that'll reduce our GST liability by $120 because we'd claimed it as income, collecting it on behalf of the government, as a liability, sorry, but because we're not going to collect it anymore, we don't owe the government that money. So we'll cross out this $100 here, and if I go minus 120, it's actually negative 20, so the GST is going to swap sides. We're going to write GST over here, and in this case, the government would owe us $20. So 100 minus 120 is 20 on the other side. Cross that off. Alright, finished all of that one. We can cross it off. All the bad debts taken care of. Allowance for doubtful debts is calculated at 5% of accounts. That's accounts receivable. So accounts receivable at the moment is 20,000. So we're going to multiply that by 5%. 20,000 times 5%, and you see that's 1,000. So our allowance for doubtful debts, it tells us, is to be $1,000. At the moment it's 800, so we need to change that. Cross out the 800 and write the new figure, and you can see that it's gone up by $200. So what's the gone up by $200? Where are we going to put that? Alright, so hopefully you've called out doubtful debts. And we put 200. So basically we've added 200 to this side, the credit side, and 200 to the debit side. So that balances. That's a nice easy one. Cross that off. Incidentally, if it went down, we'd make that one there go down, and this would be a negative figure. But you know that from previous session. Old inventory valued at 8,000 is to be reduced to 3,000 because it's old. So it's going down by $5,000. Alright, so inventory going down by $5,000. Cross out your 28. Take it down $5,000. So that's going down. What's the other half? Do you remember? It's debit something, credit inventory 5. Debit cost of goods sold. So that'll go up to 190,000. So we've got up $5,000 and down $5,000. So that balances. That's all you need to do for that one. Racing through, well done. Furniture depreciation is 10% per annum. So out of the three methods, what is it called if it's 10% per annum? What type of depreciation? Hopefully you've said straight line depreciation. Right, so 10%. So we'll write the depreciation in first. So we're going to write over here furniture depreciation. And it's 10% of the furniture. So furniture is 20,000. 10% of that's going to be 2,000. So we've added it on this side. Where do you add it on this side? Great, so we'll add it there. So adding 2,000 to the debit side, 2,000 to the credit side. Nice easy one again, cross it off. Equipment depreciation figure is based on 40% DV, that's diminishing value. So if you remember diminishing value, that is the carrying amount multiplied by the rate. So we'll do the carrying amount first. So the equipment is 42,000 minus the current accumulated depreciation on that equipment of 8,000. And that's 34,000. And we'll just put that in our calculator. 34,000 times 40%. 13,600. So we're going to write equipment depreciation hope your writing's better than mine. 13,600. I write equipment depreciation rather than depreciation on equipment because I don't have the on and it's less words to write, I suppose. And we're going to add it to here as well. So we're going to add the 8,000. So the new figure over here, 21,600. So I've added 13,600 to both sides, cross it out. And the tricky one, the last one, is the units of use. Again, quite good for a vehicle because we've got a usage of 200,000 kilometres. So we're going to sell this vehicle after it's done 200,000 kilometres. The vehicle cost us 68,000, so we'll write that in. Minus a residual value of 10,000. So that gives us 58,000. That's the amount that the vehicle is going to go down over its life. Residual value, what we estimated to be worth after that time. And then we're going to multiply it by, we used it for 60,000 kilometres over the 200,000. Notice I haven't put the thousands on there, it just makes it easier for your calculation. Back to the calculator. So we've got 68,000, sorry, 58. The amount it goes down. Multiply by. Move that calculator so we can see the figures we're after. 60 over 200. $60 divided by 200. Okay, so 17,400. So we're going to add 17,400 here. And that's your vehicle depreciation. And you add 17,400 to that too. adding to both sides, 35,400. That's hard work done. Cross it off. Well done. So the last thing I'd like you to do is go through and classify these. So we go through accounts receivable. We're going to put CA here, but remember that this one and this one are going to be part of note 1 when we do our balance sheet at the end. Bad debts, we are classified. Good cost of goods sold. Equipment. So all of these are PPE. So property, plant and equipment are basically assets that you can touch, that you're holding on for a long period of time. Sorry, that one's wrong. Inventory. Inventory's not going to be that. Inventory's going to be current asset. Vehicles is your PPE. GST becomes a current asset because the government owe us. Doubtful debts, AE. Furniture depreciation. Equipment depreciation, well, it depends what type, but at the moment we'll just put it as AE because it doesn't say shop equipment, and vehicle, we'll put that as a DC. Over this side, all of these are minus PPEs. All the PPEs here will go as a note to the accounts. And so will this one, a negative current asset, and GST, well, we've got rid of that because it's over that side. Good, that's the end of the video for today. What I'd like you to do is there's two things. Number one is Kahoot. It's going to be a bit longer Kahoot this time because I want to assess all of those adjustments, including the 6 of last time. And what we just did in the trial balance, I'll send you a spreadsheet if you can do the spreadsheet as well, and we'll have that self-marking. Great job, well done. Nice to get through another session. That's session 6, 4 to go. Doing really well. Ka kite, see you next time.